Nebius is a very popular retail investor stock. The stock is up 252% since the company went public. Again, all the growth stocks are up since then. But Nebius has done really well. It has done much better than I expected. And many of you have asked me, please give us an analysis on Nebius because so many investors are talking about the stock. And is it really a 10 or 20x kind of growth stock? Some kind of crazy life-changing returns? Or maybe it's just a hyped up story within AI, and maybe the stock is going much, much lower. Now, I did buy a lot of growth stocks this year. I bought Robinhood. Robinhood for me is up 250%, but I skipped Nebius for one main reason, and I'm going to try to focus the video on this reason and give you a different perspective from only the bullish stuff and why the stock is going to 100x. So I really hope you enjoy it as always. Now, with Nebius, just to give you a quick overview, they're mainly a data center operator, so they have those data centers, they buy up the buildings, sometimes they lease them, then they buy the GPUs from NVIDIA. NVIDIA has a small stake in the company, but they own 7% of CoreWeave, which is their competitor. They're more invested in that than in Nebius, but they do have a stake in Nebius, and they buy those GPUs from NVIDIA, and they create AI workload. And smaller companies that don't have their own capacity to have their own data centers, they get the workload, they rent the workload from providers like Nebius, from providers like CoreWeave, and from other different data center and workload providers. And this is the main business of the company. And the company is known for being efficient in terms of their power. They have their own equipments. They have their own kind of energy resources. And they're very efficient. They compete with Microsoft Azure in terms of power usage effectiveness. But again, there's a lot of competition in the space. Oracle, Alibaba, IBM, Amazon Web Services, there's just so many of them. There's a lot of competition in the space. But now Nebius is surviving and is thriving because we're still in the early days of AI, and there's so much demand, especially for a lower price. And this is what Nebius is focused on. It's focused on the lower priced tier, which I'm going to explain later on in the video. And of course, not to take too much of your time, but the company also has other kind of businesses. One of them is AV Ride, which is like an autonomous delivery, an autonomous vehicle kind of business, small business for them. I think they will ultimately sell it to raise cash and build up the data centers. Then they have Triple 10, where they train people online, like online courses and online training academy for AI and other kind of coding and other kind of things you can learn. They have 6,000 students. Then they have other tiny businesses. But the main business that we're going to focus on is, of course, the data center business. Now, the company is doing really well, guys. They put up $100 million in revenues, 106% revenue growth quarter on quarter, not year on year, quarter on quarter, 625% revenue growth year on year. You don't find any stock in the stock market that's growing revenues 106% quarter on quarter. This is insane kind of growth. The company still has 1.6, almost $1.7 billion in cash. They have positive adjusted EBITDA, which they don't have it yet, but they expect to be EBITDA positive later in 2025 to early 2026, and they expect 900 to 1.1 billion in annual run rate. And this is all pretty amazing from the business. Again, you could see the revenue growth 35 to 50 to 105. It's been absolutely stunning. And I haven't seen any stock in the entire market growing as fast as Nebius is growing. And it's very impressive. Now, if you look at the income statement, revenues went up and everything did really well. But we look at the loss from operations. Loss from operations, despite revenues going up so much, loss from operations are pretty much the same. This is not what you want to see from an unprofitable company. You want to see loss from operations decreasing over time and for the company to ultimately become profitable. Now, the main arguments that a lot of shareholders put up is that no, you should use adjusted EBITDA because they have a lot of depreciation and amortization. And normally with most companies, like here, if you, for example, adjust the 75 million in depreciation and amortizations, the company would have improved adjusted EBITDA by about 64%. So you could see it here. Instead of losing 58 million, it would have only lost 21. So this is an improvement. and they believe we should use adjusted EBITDA. Now, there's nothing wrong with that with most businesses, but I believe with Nebius, we should not adjust for depreciation and amortization because the items that they are depreciating are those GPUs. They depreciate them over a 3 to 4 year period, mainly 4 years, because after 3 years or so, they're going to have to buy new GPUs. So they have to depreciate those assets. This is not like a building that's going to last them 50 years. They're depreciating those GPUs. So I don't believe the best metric here is using adjusted EBITDA, but I'm going to explain that a little bit more. Now, in terms of the core business of Nebius, again, they sell those workloads, the NVIDIA 100 for $2 an hour. This is very cheap, very, very cheap. H200 at $2.30 an hour. So this is very cheap stuff. Now, to put it into perspective, if Nebius averages $2.20 per H100 and it runs at an 80% utilization, which is high, it would generate $1.76 an hour with 32 cents in variable OPEX and $1.14 in depreciation. And again, I'm going to explain the depreciation part. That leaves 30 cents of gross margin per hour. Over a year, or 8,760 hours, this adds up to $15,400 in revenues and $12,600 in gross cash flow, enough to recoup the GPU investment in just under 2.5 years, excluding staff and overhead. So in other words, even if Nebius runs at an 80% utilization rate, they need 2.5 years just to cover the cost of the chip that they bought. Now, if you compare it to CoreWeave is putting up $4.25 an hour. The math looks different. At an 80% utilization rate, it would get $3.40, and it would only take them 1.3 years payback, assuming similar cost assumption. And even other providers, they charge more than $4.25. Now, why is Nebius only charging $2.20? Because there's a lot of competition, and they're trying to gain market share. Could they increase it in the future? Maybe. But normally over time, when you have a lot of competition in an area, the prices of those workloads, they tend to go down. They don't tend to go up. So if Nebius has to stay at 220, they need 2.5 years to recoup the cost of the chip that they put up. And a very important reminder is that investors should also be aware that many view Nebius as an AI compute workload like a REIT for GPUs. However, there's a key distinction. While REITs benefit from physical assets that depreciate slowly over decades, GPU hardwares become obsolete within 2 to 3 years. The capital turnover is faster, the risk of stranded assets is higher, and the need to reinvest in cutting-edge chips like the Blackwell or H200 is constant. So after 2.5, 3 years, NVIDIA is going to come up with a new chip. All the other competitors of Nebius, they're going to buy the new NVIDIA chip. If Nebius wants to stay competitive, they're going to have to buy the new chips. If they want to buy the new chips after 3 years, and it took them 2.5 years just to cover the cost of the old chip, then this is a business that's not going to be making money. I'm just showing you the numbers. I'm not lying to you. I'm just showing you the numbers. So to me, the whole business doesn't really make sense. Now, Nebius is scaling it and they're growing so well because they have such a cash cushion from whenever they spin off Yandex. They could still sell businesses, raise the cash, invest it, and then grow. But after this is over, it's going to be very hard for them to really make money because they have very fierce competitors in the space, the hyperscalers, and the rates will likely remain low. If the rates remain low, it takes them 2.5 years to cover the cost of the old chip. But then after 3 years, a new chip come out, then they have to throw all the money down the toilet and buy the new chips again. So this is not a business model that made sense to me. And that's why I decided to skip Nebius. Now, I did, miss on the upside. I'm just being honest. And that's unfortunate, but I made it with something else. And to me, it could still play out. I'm going to show you the numbers. But to me, the business model, it just doesn't make sense where I would feel comfortable buying the dip. So that's why I skipped Nebius. But in terms of the shares outstanding, it's surprising they haven't been getting diluted. They pretty much stayed the same. And that has actually surprised me with the company. And it's mainly because, again, they have so much cash. They still have $1 billion. They're not going to have $1 billion for too long. They're going to have to raise money, or they're going to have to sell some of the other businesses that they own, such as AV Ride or the other one within education and other kind of assets. Now, something that's very weird from the company is they announced it's like a 20% buyback program over the next 18 months. To me, this is weird. This is a company, guys, that's in its early stages of the business cycle. They should be investing in growth. Why would they announce a 20% buyback program? To me, that makes no sense. It's a misallocation of capital. I mean, maybe next month they're going to be paying dividends. I mean, to me, it got a lot of likes, like people are cheering this up, but this is bearish. They should not be doing buybacks. And maybe they won't. Maybe they just put it up there. They don't have to buy back the stock. They don't have to execute on it. But for me, again, that would be a misallocation of capital at this stage, but they still have around 1.7 billion of cash and almost no debt. So the balance sheet is amazing. Now, if I look at the company's multiple, it's trading at 15 times forward sales, which I believe is a little bit on the higher end for a company like Nebius. But again, because they have so much cash and they can sell the businesses and they can do the data center thing, even if they break even or even if they don't lose, they take on some losses for a few years, they can afford to take some losses for a few years and they can exponentially grow their revenues. Maybe not their profits, maybe it comes in the future. But in terms of the competitive nature, I highly doubt it. Just being honest. Now, if they get the company, again, massive expectations, 158% growth in 2026, very achievable. Then 112% revenue growth, 84% revenue growth, 46% revenue growth. So again, massive revenue growth, and it's achievable because they have the cash to do it, and they're working with small numbers, $500 million, $1 billion. That's easy to grow 100%. Very, very easy. Now, if they get to $8.4 billion, or we can take $8.5 billion, the current sales multiple is 15 times. I'm going to use 10 times. And even though 10 times I think is honestly expensive, I would pay maybe 6, 7 times for Nebius, but I'm going to use 10 times to illustrate the best case scenario. Okay? Now we take in 8.5 billion of revenues by 2029, which is around 4 years from now, 4 or 5 years from now. We time it by 10 times multiple. This is $85 billion market cap. The current market cap is like 16.5 billion. We divide it by that. This is around 415% on the upside. So even if we take a multiple contraction, if Nebius reinvests the cash, and if the market still prices it at 10 times sales, you can get up to 415% on the upside over the next 4 years. So again, the company has a lot of potential. The stock has a lot of potential. I think if you like Nebius, I mean, if they can pull it off, maybe it's worth a small speculative position. But to me, again, I don't like it, guys. Like there's way better opportunities in this market, way better stocks. I mean, I talked about Robinhood, talked about SoFi, talked about a lot of them where, to me, it just makes much more sense. I would feel comfortable buying the dip, but with Nebius and the competition and the nature of the business, having to burn money every 2 to 3 years and then do it again, after 3 years, do it again, I just don't like it. So that's just my opinion on Nebius. Looks good if you're looking for a speculative position. It's really not too bad, to be honest. And even if we use 5 times sales, maybe you can get it doubled in 4 years. That's still not too bad. So the company isn't too crazy overvalued, but it's not my favorite business. And that's just my opinion on Nebius, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.